Hello and welcome to Securities Lending Live with Pierpoint. I'm Roy Zimmerhansl. I'm your host today. And if you are in securities lending, repo, or collateral management, then this is the place for you. Every Wednesday at 10 a.m., we host a live session where we pick a theme. Today's guest is Zorawar Singh from Deutsche Bank. They have a really interesting story to tell. And today's topic is cash collateral. Every Wednesday at 10 a.m., we host a live session where we pick a theme, but it's also open to questions from the audience. So if you've joined us, thanks very much. Today, the objective of these discussions is to give everyone an opportunity to uh, participate in live conversation, ask questions, share their thoughts and views. And we typically get quite a wide global audience, usually from as far away or ahead of us in time zone as New Zealand. So it's always a challenge to see whether our New Zealand watchers will be with us. And we've even had people from the East Coast of Canada and the US join us as well. So it's a pretty global audience. We haven't had anyone in from the West Coast yet, because I don't know anyone that has such insomnia problems. But as I said, today we're going to be talking about cash collateral. If you're joining us live, pop your questions and comments into the chat. We're live on Facebook and LinkedIn, of course. On YouTube, it will be on in a couple of days in a recorded format. Right. If you have a burning question or comment, put it in the chat. Other than that, I'm going to turn to our guests and ask them to introduce themselves. So, first of all, Zorawar, over to
Hey, thanks, Roy. Firstly, good morning, and to your global audience, good afternoon and good evening too, depending on where you're joining. So, thanks for having me here, Roy and John. Obviously, from my perspective, pleasure to be able to talk about what we think about cash collateral. Obviously, quite a topical thing within our program. A bit about myself before we get into all the technicalities of securities lending and cash and the world that is. I've been with Deutsche Bank 13 years, coming on 13 years. Along that period, I've actually spent a lot of time across treasury and in various structuring roles across equities and fixed income. And I've been very closely associated with the cash market, particularly securities lending, repo, and also reinvest. So a topic that is quite close to me. We've been engaged on multiple client segments on this one, so I hope to be able to provide some color. And as you know, we at Deutsche Bank are proud at what we do with our cash reinvest program. Particularly because of the way we indemnify it. So we'll talk about all of that as we move forward. But thank you for hosting, and look forward to the chat.
Great. Thanks very much for that, because I think one of the interesting things about your career is you've been in asset liability management for around a decade, if not longer. So it's interesting you're seeing it kind of from two different sides, from the bank's own position and also
Correct.
engaging with customers and what they want. So I'm quite excited about that. Now, if I can turn over to the man that used to be a weatherman, used to be the beauty of the organization, and today is the Viking representative for the show on the day when England is playing Denmark in the Euros. So over to you, John.
Well, firstly, we can't exactly include Danes as part of the Viking history. We all know that Norwegians are the only real true Vikings. Now, secondly, I hope there's no Danes listening to this. Morning, everybody. John Arnesen. I'm the consultancy lead for Pierpoint. Prior to that, I have a very strong pedigree in agency lending, running agency lending businesses. And Roy, on the point of anybody joining from the West Coast, if they were to do that, it's very likely they haven't been to bed yet, which could make for an interesting discussion.
It's actually quite interesting you say that, because we do a live chat on Clubhouse, and it's actually quite interesting. If you go onto Clubhouse, which is an audio only social platform right now, you will find quite a lot of people on the West Coast just starting rooms right now, despite the fact that it's sort of 2 a.m. So you're 100% right with that. So well done. It's right. So now let's actually talk about cash collateral. It's that time of year again, and it's holiday season. And so our first commentator is Ludmilla, who normally joins us from Dublin. And I suspect that Sardinia is sunnier than all of Ireland and all of the UK combined.
And not a business trip.
Yeah, probably not a business trip. So thanks for joining us. Much appreciated, Ludmilla. And if anyone else is out there, tell us where you are watching from. We're looking forward to hearing from quite a wide interest, because to me, cash collateral is both the history of the business. It's been in kind of a downtrend over the last decade. But we've also seen the fact that people that don't get involved with cash have missed out on opportunities. So I think it's quite a wide ranging topic for us to look at. So maybe Zorawar, I kind of alluded to it in the opening comments, but maybe you can just tell us a little bit about Deutsche Bank and what your view is on cash collateral and where you're going with it. So maybe that'll be a good starting point.
Yeah, absolutely. Look, I think from our perspective, cash collateral has always been a key feature of our program. Now, obviously, dealer balance sheets, regulations, markets, they're all changing, and we always need to adapt. And if you ask us the same question 10 years ago versus where we are today, things are different. So let's not kid ourselves about that. But I think for us, cash collateral is a very important part of our business. Why? Because when we lend securities, we whatever cash we take back, we prefer to reinvest in the repo market by and large, unless, of course, clients wish to deploy their cash differently, and we'll work with them whichever way. But we also indemnify whatever repo we undertake for our clients. Why do we do that? And a couple of other perspectives on that in the more recent past. We believe, from our perspective, when clients look at choosing us as agents, it is very important that they know that we have skin in the game. And our indemnification at the end of the day makes it very apparent to the client that we as a bank are taking risk-weighted assets. Our credit risk management teams are evaluating every transaction. And therefore, we have full transparency and control over the risks that we're effectively undertaking, which are not only reported to the client, but are also risk managed internally within the firm. The second aspect of that is, we've actually now seen and have actually realigned our internal kind of setup, where we are not really in the global custody business here at Deutsche Bank. So we've always been a third-party agent lender, i.e., we typically work on a non-custodial basis. We also saw that with cash, there's a lot of clients that we haven't actually gone and even talked to about how they should be how we can actually help them manage their cash, not from securities lending, but generally their excess cash positions that they have. And so in the last 3 months, we actually looked to realign our business from our custody side of the house to our cash management side of the house, still within the corporate bank banner, which is where both these businesses sit. But actually, it opens us up to a whole new client segment, which is our corporate client franchise across Europe, across the globe, where we can actually talk to corporate treasurers about what they are doing from a liquidity management perspective. Why do we think that's important? Because, it's no secret the banks are flush with liquidity. Rates are at rock bottom or negative. And clients need non-deposit alternatives to managing their cash, particularly in the corporate space. And therefore, we are seeing good dialogue on that front, and that's something that we look to expand on within our business. It doesn't really take away anything from our securities lending business. It actually accentuates our program because we become more interesting to the market in terms of what we can bring to the table and the volumes that we can do, which enables us to actually improve our stock loan side of the business as well to align trades that can capture spread best.
Great. So, I think that's a great introduction, and I think just what you've talked about there is enough for a show in itself. So, I'm going to turn over to John in a second, But first, I want to say hello to a couple of other people. Sogandika from India. So I hope I pronounced that correctly. You're one of my contacts, so I will make certain to find out how to pronounce it correctly. So thanks very much for joining us. And Dharmendra is joining us from London as well. So thanks very much for being with us today. John, listen, I just want to turn over to you because you've had a lot more experience as a lender taking cash collateral than I have. And so maybe I can just kind of ask you for your thoughts and views on this.
Yeah, I mean, the reason why we're having this discussion today was actually my idea, because I sometimes think that cash collateral gets a bad rap in the market in general. And there's a big distinction between, obviously, the US and Europe. And I think we're getting to the point now where we're describing Europe as a sort of non-cash market and the US as not, for regulatory reasons more than anything else. And yet, I think back to the early 90s at Bank of New York, where we ran a fully cash reinvestment program in multi-currencies, and this is back in '93. And in fact, Zorawar, you'll know this, but we felt our main competitor at the time was Deutsche Bank, who was doing very much the same. And yet, obviously, there is a difference now because we have a very different interest rate policy between the two countries. And I guess one of my first questions would be, when you describe you taking cash, is that equally weighted between your US activity and your European activity? Or is there very vast differences in the volume between the two?
No. I mean, the US market is far more cash oriented for various reasons. I mean, 15C33 being one, but we see a whole. I would say.
Maybe I can just ask you to explain that, right? When we do acronyms here and everything, we like to explain this. So I suspect most of the non-US audience won't be familiar with 15C33. So maybe you can just give us a quick sentence on that.
Yeah, I mean, I think in the US, there is a restriction on broker-dealers being able to collateralize stock loan agreements with non-cash collateral that is wide-ranging. So I think there's a very restrictive list of collateral that is allowed under a stock loan trade. As a result, equities, high-yield bonds, etc., are particularly not available for the non-cash transaction to work. That, however, doesn't apply to banking firms or for that matter, transactions undertaken through a repo agreement. So, there are ways in which you can align yourself, but in Europe, those restrictions don't exist, and therefore there's a whole market which has developed around doing upgrade transactions or downgrade transactions, depending on whose perspective you're looking at it from. And as a result, you're able to capture spread in economic terms, achieving the same outcome without having to deploy cash. And why has cash become a lower kind of utilized commodity within the European stock loan space? A, yield is an issue, and B, at the end of the day, since the leverage ratio really started to bite, and by the way, this is true for the US as well. Institutions have become more, let's just say, cognizant of how they deploy their balance sheet, because at the end of the day, one of the great things about repo and stock loan is that these are very low risk transactions by virtue of them being collateralized. But the downside is that they do consume balance sheet. Now, historically, pre-crisis, that was not a problem. As regulators have sought to kind of introduce non-risk-based measures, such as the leverage ratio, that's become a biting constraint on balance sheet, which is why this kind of non-cash versus cash argument.
Right. So just to clarify for everyone in the audience, almost all of the ideas for the shows are John's. I'm just here for my good looks. I want to say hello to Johannes, who's joining us from Jakarta. So I think at the moment, Johannes, you are leading in terms of the furthest east of our disclosed and declared viewers. So welcome to you. But John, the interesting thing about when you were putting it in the context of the early 90s, that's when we actually had currencies. So across Europe, one of the challenges, though, wasn't it that the money markets in sort of France, Germany, the big currencies weren't really all that liquid, and the UK was too volatile. I mean, what were the issues you guys faced back then?
Well, I mean, yeah, you're right. I should put that into context. I mean, the cash we raised then, which which was actually from the borrower's point of view, freely given. In fact, if I wanted non-cash, it was more difficult to do so. But we only ever invested that in reverse repo. There was very little other product at the time that we could actually access in the way that our US colleagues could. Of course, that did change. That changed with the introduction of the euro. In fact, reverse repo was probably only the target was probably to be 50-50, but the other 50% was very much invested in other investment vehicles. Asset-backed CP particularly was a favorite of ours, especially if it was A1, P1. But we would buy, out to 2-year medium-term notes. But that's when we had a yield curve that made sense. So one of the things I struggle with now, Zorawar, is if you do accept cash, and let's say that it's probably, I guess all your government lending activity is probably non-cash because of HQLA. But if you were to raise cash in that environment, in a negative environment, what do you buy if it's outside reverse repo, if at all?
So I think, look, we take a very holistic approach to the loan transaction, right? So we do not want to lend or raise cash, obviously, where it may be okay to have a 5 basis point rebate on a transaction, or less, frankly, but you don't have a cash reinvest on the other side lined up, right? We need to capture spread at the end of the day. That's the way we generate revenues in our businesses, and as a result, that spread capture is very important. I think your question earlier was, if you were to ask us our European versus US spread, right? If you look at our European book, 50-50, 60-40 cash to non-cash. If you look at our US book, it's far more on the other side of that. If I'm honest about how do we manage our cash reinvest, at the end of the day, in Europe, a lot of our clients don't even allow us to do tenor mismatch, whereas in the US that may well be allowed. So I think particularly what's important to us is that we run a matched book. We manage the risk between the tenors on the trades. And what we find is that on the reinvest side, as long as you have collateral flexibility, there is still spread to be had. Now, with Europe, as the central banks are introducing various measures to flatten the yield curve, be that the TLTRO, be that the various ECB measures that have happened in the recent past as a result of the pandemic, the curve has gotten flatter and flatter. And therefore, to be honest, you're also seeing that on the non-cash trade. If you try to lend government bonds versus equity collateral, 2 years ago versus where you're at now, I think those spreads are ever compressing. And at the end of the day, the cash trade only allows us to be able to find different counterparties. So we may find that there's a demand for particular securities with one counterparty, but we may find that there's a financing demand with another counterparty. So, which is why the cash trade allows you to actually work across counterparties and actually capture different balance sheets and dynamics in the market. Whereas if you do the non-cash trade, you're kind of aligned to the borrower's kind of demand for the asset, but also their ability to fund it with the or collateralize it with assets that they've got on their sheet. So you've actually got a bit of a restriction if you restrict yourself to one counterparty, whereas you have the ability to diversify the trade, where you can capture the best price for the in-demand asset, and you can actually capture the best price for the funding transaction or the reinvest transaction.
You make a very good point there, because I've always maintained that cash is actually the best form of liquid collateral across the board. It's what you do with it afterwards is where the sort of the discussion has to be had internally as to what you do with it. But if every one of your clients took cash and every borrower is awash with cash, it actually is very, very liquid. And you don't have this agony over in a non-cash environment where, this client won't take this form of collateral, and that's all the borrower has to offer. So you could then reverse in that collateral, in my opinion.
Exactly.
But then we enter into, there's a question here about haircuts and asking for an explanation. I don't know. I mean, there are standards in haircuts for both cash and non-cash. And I always was quite attracted to the fact that if I lend versus cash, I take a I take a haircut of 2%, maybe if it's fixed income. I then reverse repo that cash and then take a margin of 2%. So I'm double margined on both sides of the transaction. Whereas if I'm only taking non-cash, it's only once. And I thought that added another layer of protection to some extent, but it's probably not that significant if you actually face a credit scenario. But is that still in keeping with roughly what's going on in the market, or is there now a hierarchy of haircuts or margin depending on counterparty credibility, creditworthiness?
So I think this idea of excess cash collateral it's not really prevalent so much in in Europe, but more so in the US, right? So there are some regional dynamics to what you're saying. The second aspect is, at the end of the day, what is a stock loan transaction trying to do? I mean, if you look at it, either it's trying to capture a special where the cash is in, where the collateral is really trying to risk mitigate the counterparty borrowing the particular security in context. I think specials trades, it doesn't really. It's more about making sure your credit risk collateralized. At the end of the day, you're capturing the spread. The extra 5 or 7 basis points you're going to add to the 100 or 200 or 300 that you're trying to capture. Sure. Frankly, it's rounding errors. You look at that in the more kind of structured trade, which is the typical LCR trade that came out of the crisis. I mean, I always like to say this, right? Liquidity in the past was an observed phenomenon, right? A trader knew, oh, that bond is liquid because I can see you can flip it in 50 million clips, like multiple times a day or not. Whereas today, liquidity is a defined concept. The regulators went and defined what is liquid, right? So what started to happen as a result is that the structured trade is very much dealer balance sheet driven. It's very much this regulatory style trade. And so what we're finding there is it all comes down to the basis points are highly correlated to the haircut you want to receive. Now, there's a point where that kind of optimization curve flips one way or the other. How much basis point do you want to capture versus how much risk do you want to take? And that depends on, obviously, the risk parameters your clients have, the counterparty has, or your indemnification has. And that's really where you've got to kind of balance the three things. But from our perspective, we don't really so much care if a client wants to do a non-cash trade or a cash trade, because we want the counterparty to give the risk haircut for the basket that we're taking. So if you're taking equities as collateral, there is a credit risk kind of haircut that we want to receive for that. And whether I'm doing that in a cash trade or in a non-cash trade, that is important to us. I think in the US, particularly because of this 2% extra that can be captured, I think it's a good practice. Arguably in a stock loan transaction, what's your risk when you're 100% collateralized? It's the kind of VAR or the volatility in the asset that you're lending in the event that your counterparty is gone, right? At that moment, you're likely to be buying into a rising environment if it's good quality fixed income, or into a declining environment if it's equities. Now, it depends on the individual circumstance, and you're talking about a big dealer default. If we knew when this was happening, we'd all be in a different place. I think that the point from my perspective is a 2% collateralized trade, actually, from a risk perspective as an agent, from a risk perspective as a client, is great and is really helpful. But if it's not collateralized to that level, then effectively we as a dealer from an indemnifying, or we as an agent from an indemnity perspective have to take more capital costs. And so eventually that gets priced in the profit sharing agreement that you have, or in the trade that you're doing. So someone's paying for all the economics of a transaction. So for me, it's about managing that.
Can I just ask you again? You've both talked about sort of margins and haircuts. Can you give maybe just simplistic examples of how that works, just practically in a typical trade? Maybe Zorawar, maybe you want to start.
So let's take two examples: a cash collateralized trade and a non-cash collateralized trade. So typical cash collateralized trade is someone lending an equity position or a corporate bond or a bond or a government bond versus cash collateral. So we lend 100 million worth of something, we receive back $100 million worth of, or euros worth of cash. or 102 in the case of the 2% extra that we're talking about, so $102 million worth of cash in the US. That cash then needs to be reinvested. And in the reinvestment trade, let's say we're reinvesting against equities, we may be taking 7, 10, 12%, depending on what kind of equities you may be taking as collateral. That $100 million that you would invest, or the $102 million you would invest, would come back with 110 million or 112 million of equity collateral or corporate bond collateral, depending on the risk parameters and how you've sized your haircuts. Same transaction in the non-cash world. Lend your fixed income position. This is more commonplace in the fixed income market, but so you lend your fixed income position, particularly government bonds, $100 million or 100 million euros, and you may take back 105 million of corporate bonds as collateral, or 110 million of equities as collateral. This is now a non-cash trade, but in essence, you've just netted out the cash leg. In effect, and that actually helps the dealer balance sheet because of the leverage that they don't have to undertake, but it still achieves for the client the return that they wish to achieve from the guidelines that they've set for themselves in undertaking that stock loan transaction.
Zorawar, it's fair to say though that the margin is on the collateral in a non-cash transaction, and therefore the fee of the loan is reflective of the value of the loan transaction. So in fact, correct, cash is slightly more attractive because you're actually investing and getting a return on the margin piece of the collateral. So it's, yes, I mean, it's kind of a quibble, but it used to annoy me at times when you're leaving if you over the course of a year, there's a fair amount of difference between the two. Now you mentioned, you said investing in equities. Now, can I just clarify that when in your example, you meant reverse repo of an equity basket?
Correct. Reverse repo of an equity basket. Sorry, I should have clarified that. Obviously, yeah.
How liquid is that transaction in terms of the number of borrowers willing to do that?
So look, equity balance sheets are obviously thinner than the fixed income balance sheets. I think I wanted to. I'll see if I can put out a number as we move along. But if you look at the U.S. market, you would say 80% of the collateral available is in the liquid fixed income space. What is available at the end of the day, prime brokers are still there. There's still equity houses on the street. They still need to finance that inventory that they hold. Now they undertake multiple different types of transactions to fund that inventory. But one of the ways in which they use that inventory or general collateral that they have is actually to fund that via repo. We are actually, particularly in the US, we are, a double-digit percentage of the US equity market in terms of the repo funding that we provide into that space. In the European space, equity collateral is. This is the other thing. It's the way the dealers are set up as well. So you'll end up talking to a repo desk on the fixed income side, and you talk to an equity finance desk on the equity side, and they're often not doing the same transaction, right? So it's where there is a slight difference. From a liquidity perspective around, and I guess your question, John, is about credit risk of the collateral that we're taking, right? Look, I talked about observed liquidity. Liquidity in equities is a far more observable concept because you know what the average daily traded volume is. You go on Bloomberg, you can see it. Fixed income, on the other hand, OTC market, obviously, still not it's partly electronic, moving in that direction. If a bond is particularly special.
Just to be clear, moving very slowly, right? People electronify the bond market since the 90s, and no doubt there'll be people that tell me it was actually before that. But anyway,
yeah. Look, the equity guys are way ahead on this, but I think on the collateral side, it all comes down to how you then take your value at risk or your risk model. We found that in various different stress scenarios that we've run, the equity book is very liquid. There's a price you can see, you can actually act on it, and typically you're able to get good haircuts in the equity space. If you try to ask for double-digit percentage on a fixed income transaction, fixed income collateralized transaction, you'd struggle a dealer giving that to you, because they've got different use for that, and particularly because the size involved. You're in an equity collateralized transaction, you're not typically doing more than a few 100 million, right? Or maybe 50 million clip sizes each trade. 10% is only 5 million. When you're doing fixed income, you're taking 150, 200, 500 million in collateral. That 5-10% can very quickly begin to add up for the dealer. At the end of the day, that amount of collateral that they've given in haircut size needs to be funded unsecured.
Absolutely.
For that dealer, and that costs money. And when that costs money, you're gonna suffer on your stock loan spread or on your bond loan spread.
And I just want to add one point on the equity liquidity point you made, and because this applies to both equities as just non-cash collateral, just direct equities, and also as equity repo, as you say, because the reality is the liquidity is even more robust than what we've been talking about because of your collateral schedules at tri-party providers. It's the most recent liquidity of each of the individual securities as they change. So if you had a security that was quite liquid because there was a lot of turnover 2 weeks ago, and your collateral profile say, well, the last 5 days liquidity, then it doesn't matter what happened 2 weeks ago. You are talking about constantly evolving current liquidity.
Correct. So, and it's transparent pricing. Fixed income, a tri-party provider is taking a price. Yeah, it's a good enough price, but is it the traded price?
Yeah, and look, we know from history with the Lehman default, and actually I ended up coming across this quite coincidentally, and then because I was involved in a expert witness legal case, I ended up having to prove it out. But Lehman actually ended up, from their client positions, having a huge position long UBS shares. So if you can imagine that there's a normal day-to-day turnover, the whole market got disrupted with Lehman's default. Financials were hurt particularly badly because of knock-on effect on other financials. But so the market had to absorb the normal liquidity from day-to-day trading, the excess liquidity from the concern over the Lehman default, and then on top of it, a massive piece of UBS, which Lehman had been able to use as collateral because they were entitled to with from their client agreements somehow. And the market absorbed all that. And so while there was an element of price reduction, the difference between the UBS shares and Credit Suisse shares, for instance, was really marginal considering the excess supply. So to me, that was the proof case for the value of equities as collateral in a crisis.
Yeah, look, I mean, we're not, first of all, these are publicly listed equities we're talking about, mostly on an index. If you were talking about, other different equity stakes or block stakes, which were privately valued, I think it'd be a very different kind of ballgame, right? So I think for me, we're quite comfortable taking equities. We don't mind taking equities. We like taking equities. I think the spread there is more interesting. It actually, in fact, is more justifiable. I mean, if you look at the spread compression that's on in the typical downgrade trade, where 40 basis points used to be the dream, right? In the ultimate trade that you used to do in the 3 months or whatever. Good luck trying to get that today. I think the supply is so much more.
I had one client who said, when we first started talking about collateral upgrades, they said, yeah, listen, tell you what, when it gets to 30 basis points, give me a shout. So, well, if we wait until it hits 30 basis points, then by the time you look at it, get approved, sign the documents, and get ready, that trade will be gone. And so that window is sort of long gone.
But I think the regulations are interesting here as well, right? Look, LCR brought about the kind of, I don't want to say birth, resurgence, or whatever, the creation of this non-cash trade, lending good quality fixed income, level 1 HQLA assets for investment grade, high yield, or equity collateral. It was a very beneficial trade because the liquidity coverage ratio of a bank goes up, especially if it's 30 days or longer, or 60 days or longer, or 90 days or longer. Typically, those were the trades that the market starts seeing post-crisis. NSFR has yet to bite. So if you look at what NSFR is going to do, it will bring cash back on the table. we are convinced of it. We're seeing some dealers already move in that direction. It's still early days. I think the regulator, although they announced both the ratios very close to each other, as the Basel Committee published their papers, I think the implementation of NSFR was delayed. It's now beginning to kind of phase in. And we actually see securities lending agents being able to capture value. And that's one of the reasons why when we talk to corporate treasurers, that's one of the things we're highlighting to them as well, because corporate cash is seen as more stable from a NSFR perspective than financial cash, if you want to call it like that. So it's quite a interesting development where as NSFR begins to make its way through the dealer models, those spreadsheets will start to want cash again.
Could I, Roy? I don't know if you got something, but I just wanted to rewind slightly to a point you made earlier, Zorawar, in that if you were doing a cash loan against, and you're going to reverse in a basket of equities, so you've got cash on both, so you've got cash in and then cash reinvested. Is the economic output of that identical to if you did that on a non-cash basis, or is there an advantage? All things being equal. So, because I used to take a huge amount of equity non-cash, and I want to come on to how that settles actually in a minute, because I think the audience might find that important. But was I missing out by not doing it, expressing that as a reverse repo instead?
So it depends on the balance sheet and the dealer you're talking to, right? So generally, economically, the trade is the same. If you're taking S&P 500 equities as collateral and you're lending a government bond, whether you do it versus cash or versus non-cash, you should typically be in the same position. Now, you made a point very early on in this conversation about this 2% or this extra collateralization you can achieve with cash in some markets. I think that aside, economically, the trade is the same. Can you find price discrepancy in the spread that you're able to achieve because you managed to do it with cash? I think I alluded to it earlier. Different dealer balance sheets, different funding spreads, different price. So if you're taking S&P 500 from all the dealers, one dealer might be paying you more because their CDS is higher, and therefore their funding spread on their bond market is higher. Therefore, they'd be willing to pay the extra 2 basis points if you were to give them cash. And you could actually realize the stock loan value or the special value or the GC value from a lender who would maximize that. But I think if you take that out of the picture, economically, the trade is the same. Do we find there's more spread to capture? Yes.
So is it still the case? I mean, I'm going back a few years now that in that transaction I described, the entity that you lent the securities to would want you to give them the cash back, or do you just shop that cash around to any other? So in fact, you have one transaction with A and you're investing the reverse repo with B, or does A want both sides of it?
So I think if you're doing there's a clear reason why A wants both sides of it, because there's balance sheet netting that you can achieve if it's the same counterparty, same clearing system, and same maturity date on the trade. So if you, without getting into arcane accounting rules and regulatory rules, but from a dealer perspective, if they want to do that versus cash, they may see advantages to net that transaction down by actually capturing both sides of the trade. We may have clients, however, who say, well, hold on, I don't necessarily want to reinvest the cash. I want to reinvest. I want to take my cash back. At that moment, that transaction doesn't fly anymore. So it depends on the underlying client. It depends on the program guidelines we're having to work to. But we try to balance both these things out. Obviously, from our perspective, if the dealer is giving us a good price for that trade, whether they wish to do it cash or non-cash, we should be fairly neutral to it. Because at the end, the risk that our client is taking, the yield that they want to achieve is the same. It's just how we get there is a different outcome.
Yeah. So listen, guys, one of the things that we haven't touched on is negative interest rates in Europe, right? And that obviously has an impact on what you can do with cash and why some people want to give cash and why other people don't want to take cash. But there's a specific question here from the audience. asking about this sort of this view. Is it better to take cash collateral or non-cash collateral when interest rates are negative, or if you're going to be, by definition, then if you're going to be taking cash that's negative, how do you actually deal with that? So maybe both of you can comment on that if you like. And
It's
sorry,
amazing.
a quick hello to Martin, who's joined us. And for any of you in the audience, if you are a lender now, do you take cash collateral, as the question asks? And if you don't take cash collateral, what's your reason? And we haven't even you've talked about risk, but we haven't really talked about risk yet. We will come to that, but maybe let's go back to the negative interest rate question.
So, look, negative interest rates. It's a common question we get. Look, negative interest rates. If you raise cash at -50, you want to make sure you're investing it at -40, right? That's the only way you're going to capture the spread. So it is corny in your head, but until you're used to the idea. But it's very important that negative interest rates don't impact, at the end of the day, the outcome. Clients come to do stock loan to earn spread. If you raise cash cheap and you invest it at more than what you raised it at, you will capture spread. So keeping the interest rate aligned, making sure you're not running basis risk, those are other aspects that need to be considered, but negative interest rates don't take away the need to take cash collateral.
So 20 basis points is 20 basis points, whether it's on the positive side or on the negative side.
If you're making -20, don't do that trade.
So on that basis, outside of reverse repo in whatever instrument, I mean, so our issuers are managing to issue relatively deeply in the negative space. I mean, -30, 40, quite freely.
Yeah, I mean, SSA issuers, you look at some of the, CPs being issued. I mean, corporate CP is one. I mean, obviously there's some credit element to that. But if you look at SSA issuers or state issuers, you wouldn't be remiss if you found people issuing at -50. I've even seen sub -50 issuance in CP in short dates. So, there are also opportunistic players where they will just issue because they can. There's demand for CP, and they'll issue the note and reinvest the cash in repo to capture, even if it's at -49 or whatever, just to capture a few basis points.
Yeah, if the spread's there, they'll take advantage of it.
Yeah, I mean, there's leverage constraints. Nobody wants to just lever a balance sheet because let's capture 2 basis points, right? But it's possible.
When we first entered a negative environment, did you have to trick your system into understanding what was happening with rebate and receivables and payables, because it's flipped on its head to some extent?
Yeah, I think there were aspects of the system that were able to deal with it, and there are other aspects that don't, and especially depending on your technology stack and how many different places you're passing a trade through to get to the end result. I would say we had to do a bit of development, but we've been amazed at how nimble we've been on that one, to be honest. I think we may have surprised ourselves a little bit. So that may have something to do with the way we were able to amend our technology to be able to handle it, or for the fact that the way our stack is, there's not that many changes we need to make down the line. It did mean that we ended up doing some things manually. It did mean that we needed to track certain things offline. But as the markets, look, negative interest rates have been now around here since. I mean, it's been a decade nearly, or coming to. Yeah, and if you're not used to dealing with it by now, I think
it means you're still doing it manually, which is a problem.
Yeah. I mean, look, there's a reason the Bank of England, when they talked about negative interest rates, now they've moved away from talking about that in the short term, but they did a consultation with the banks to see whether their systems would be able to handle it. I think when a regulator or a central bank publicly puts that out there, it gives you a view at how much they already know about what constraints are faced by banks in that space.
Yeah, and look, that's how it got introduced, right? So early on last decade, they were sort of floating the idea in the various money market committees and securities lending committees, saying, well, what do you think about negative interest rates? And people going, well, I'm not even certain I can trade on that basis. And in central banks as counterparties was a question as to what would they actually honor negative interest rates? Were they obliged to do it? So I think it evolves, and as you say, they kind of put it out there so people start looking at it, and eventually it plays through. Look, what we haven't talked about is risk. And just to be clear to everyone, there are no returns in this world without risk. And if securities lending cash reinvestment offers extra basis points and extra returns, then there must be a degree of risk. And if you look back at the history of the business, the biggest losses haven't come from entities like Lehman defaulting. They've come from problems that relate to things that have been done with cash collateral. So let's talk about that, right? Because I guess there's a couple of things. So number one, Zorawar, you guys are talking about looking at cash and actually extending it out to people's just full cash portfolio, not whether it was raised from securities lending or corporate activity. Number one. Number two, you guys also indemnify, which I think is interesting. But let's talk about risk. I've got lots of challenges I can throw out, but I'm interested in hearing from both of you from your different perspectives. So Zorawar, maybe you talk first.
I mean, from a cash collateral perspective, the risk from our perspective is very, very clear. Right? I think we've talked a lot about reverse repo. Like if you are actually looking at investing into other asset classes, look, I think you need to evaluate the risk for what it is. I think there are specialist investment managers that we encourage our clients to work with. That doesn't mean we're recommending managers. We're just, our clients are working with investment houses to actually construct their reinvestment portfolios where they're doing outright purchase of assets. Now, historically, money has been lost in the cash reinvest space. 2008 ABCP blew up in some fashion, and because the number of people that were just relying on the headline rating to evaluate the risk on that, I think they suffered. I think that it's fair to say the securitization market, the transparency, the focus that has brought in risk management departments has meant that people do a far more deeper analysis from a look-through perspective as to what they're actually buying into. At the end of the day, as you said, Roy, risk, there's no such thing as risk-free, right? I always say risk cannot be eliminated, it can only be transformed. And from that perspective, no matter which transaction you actually undertake, you need to accept a certain degree of risk. And whatever that degree of risk is, you need to make sure you're fairly compensated for it.
Right. Thanks a lot. John, you've been around long enough that you probably, well, look, I've been around longer. I know it's hard to tell, but you would have been, based on the timing of when you started, there was actually a big commercial paper that actually went into Chapter 11 protection. So they weren't insolvent, they were protected. And the agent lender at that time who'd invested in that commercial paper actually said to clients, well, the contract says you bought it, it's your risk. So you guys need to give us the cash back so we can give it back to the borrowers and you hang on to it. Now that company ended up coming out of administration, coming back, paying off its debts. So there was a funding issue, but literally the day that the client paid off, every single client of that agent had already arranged to move their custody and securities lending to another provider. And so the next time there was a problem, which was a couple of years later with inverse floaters, which you must have been around for, that started creating this moral hazard of, well, we'll just rely on the agent to protect us. So you've seen quite a lot, John. So what do you think?
Zorawar put it quite well, and I'll just add to that in that a lot of cash collateral in securities lending transactions will end up in reverse repo, which is usually in government debt. It doesn't have to be because we talked about equity, but it's an added protection in the sense that your counterparty is likely to be the same people you're lending securities to. So you've done the credit analysis on them, and you have a repo transaction does have certain sort of unwind protections that's afforded to you. The real spread though comes from outright investment in other instruments, and it's clear that during 06 to 08, it was a bit of a bloody mess, frankly. That illiquidity problem, that credit crisis, put a lot of paper at risk, and in fact, a lot of it did default, and the losses are, they have eight noughts after them. So we know why that happened, but does that mean that you shouldn't continue to look at exactly what your underlying client base is probably doing? Because when you think about it, if your underlying client is an insurance company, an asset manager, a central bank, they have bought the assets which you're lending, and they're very familiar with the process. What I think changed after 08 is that an agent lender would typically have a reinvestment desk as part of its, as part of its team. And I think that radically changed in that you now had to carve that out and give it to, I don't want to use the word professional asset manager because that's what they were doing. The function was an asset management, but it became kind of embedded outside of the business itself. And either that went to your internal asset management company or it went elsewhere. And I think that distinction was probably the right thing to do. The risks are understood by those clients that accept cash because that's exactly what they intend you to do with it. But you're not buying 30-year final maturity paper with it. You're probably buying fairly limited. You probably have an average weighted life of less than 2 years or whatever. And as Zorawar said, you're going to the research into that product, if it is, for example, asset backed, is going to be fairly deep. It's going to have a history of issuance, and it's probably relatively safe. I say that with some caveat, but you're not trying to do. You're not investing like an insurance company would have to. You don't have to take that kind of duration risk. But obviously, if yield curves were relatively normal and steeper, there is some advantage to this, which I think is probably ignored to some extent, particularly in Europe, even though we have to get to a different environment, but not necessarily. And therefore, there is a potential missing a trick if cash is not something that you're prepared to even think about. So, with Deutsche Bank, they, as we've heard, very flexible about what the client wants to do, what the borrower wants to do, and they can do either or. If you haven't got that opportunity, and let's say there was a liquidity problem in Collateral, and the cash was in fact awash everywhere, you may actually miss out on the loan side. So that probably isn't going to happen anytime soon. But not having the flexibility, to me, is why I wanted to have this discussion, because I think there are probably too many lenders that have just rejected cash outright, and I don't think that's the right thing to do.
Well, and might I add, it's not really a risk answer to your risk question, Roy. I think it's another trick in your armory, right? The reality is, the number of conversations we're having with clients about liquidity management, right? And I love to talk about this partly because I guess I come from an ALM background, but at the end, securities lending started with the revenue generation principle. It is a you engage in securities lending because you want to make money. But you can also engage in securities lending or securities finance, let's call it more technically, because you want to lever, or because you want to borrow cash, or because you want to use cash, or you have excess cash that you need to deploy. You can have liquidity management objectives that, yes, don't fit with the traditional definition of what is a securities lending program, but that doesn't mean you can't use securities lending to achieve those outcomes. And I think you actually do use those outcomes. You may do it with a repo desk. Well, why is repo any different to stock loan? It's just a damn underlying agreement that is slightly different. So from our perspective, we see the two as synonymous. We want our clients to come to us and say, it's not just revenue, it's also liquidity management. And because it just makes it a far more holistic conversation. Because if you can actually help the client manage which clients are there for liquidity and which clients are there for revenue, you make the whole portfolio available, as opposed to clients trying to segregate boxes for what is actually there for revenue and what they want to kind of do liquidity with. So there's a huge discussion around that.
One of the debates that came out of, and I'm kind of getting a little bit tired of going back to Lehman, and this is all 14 years ago now. We should get over it. But one of the debates that came out of that was it's all very well for the agent lenders to make money on the lending side, but the minute anything goes wrong, it's all my loss on the reinvestment side. And I remember being in a Boston conference in 10, where I said, why isn't there more of an equal sharing of the losses on the reinvestment side? When I got shouted down off the stage. Do you think that's something, though? I mean, indemnifying reverse repo as you do is something that a number of agent lenders do. But when you think about it, all non-cash collateral transactions are indemnifying the collateral they're taking on a non-cash basis, because if they're running an indemnified program, they're not distinguishing between the collateral. So if you're taking equity, it's all indemnified. Therefore, the concept is already there from that side of things. Do you think that reinvestment losses should have a wiggle room to be more mutualized, if at all?
I'll answer that in a very crisp way if I can. I would say, I think as agents, we should be responsible for counterparty credit risk, which is contingent. Yeah. If we start becoming responsible for investment risk or market risk, which may materialize because of credit risk, that being said, sorry, I'm using terminology, but outright investments are an open eyes decision made by the underlying client. They have the benefit of all of that. We are simply an administrator in that process. Investment in reverse repo or contingent credit risk instruments, such as securities finance transactions, it's a whole lot easier for us to indemnify, because if you think of the risk that we're taking, it's contingent and it's collateralized. Buying outright paper is not, and it belongs to the underlying investor. So we will, in fact, it almost puts the onus on the underlying client to therefore do their risk analysis very carefully, because if you're not, you cannot outsource that problem. We cannot guarantee investments that are out there in the market that you've chosen to buy. We are simply an administrative process provider in that reinvestment process.
Okay. All right, guys. So I think you both make some great points. Let me just say in the final closing minutes. So I'll give you both a chance to have your final say on this. But look, first of all, I think the difference is between now and times of loss in the past is that securities lending has been used as a vehicle to raise cash to chase yield. And where there have been losses, it's not been because of the securities lending transactions. It's because of the disconnect and just hunting after yield, right? And so I think to an extent, what both of you have talked about is the idea of where you're buying outright instruments. It's actually more in the hands of professionals and people that do this as the core of their business. So I think that's a good point. But look, John, I have to actually fundamentally disagree with you. We should never forget Lehman. We should never forget Drysdale from the early 80s. We should never forget reverse flow risk, because we've ended up here because there have been a series of errors and bad decisions made that we've only found out they're bad decisions with hindsight. So never forget those old things, because there's something lurking around the corner that we don't know about or we haven't thought about that will generate the next phase of losses, right? Because that's just what happens with markets, right? Every sort of 7, 12, 20 years, there is something new that comes up in securities lending, cash reinvestment that we've never considered before that rears its ugly head. So I'll leave that. But look, I think that the thing that I really want, that I've taken from this and my own view, is that one of the reasons why you want to have that widest range of acceptable collateral as a lender is, if you're comfortable with all of those different aspects of it, is that you need to be flexible to cope with market demand. So if you go to 2015, in the run up to the U.S. elections and some of the political events there and Brexit, long positions for hedge funds and banks were declining. And so by the end of the year, you were running out of collateral anyway. So if you didn't take cash, you were just out of the market. So I think you've talked to us, and you can't tell when that's going to happen. And banks have become a lot better at sourcing their financing to cope with some of the regulations that Zorawar that you talked about earlier. And so I think banks are just smarter at how they finance themselves. So the reality is if you're too narrow, you lose opportunities, and you might be okay with that, right? You might want to say, I don't want to have, I'm not in business to do securities lending. I'm in business to make returns from my investment. And if I can generate extra returns, then that's great. But that has to satisfy my requirements. So I think your point, John, in setting up this session in the first place was it's not as simple as just cash or non-cash. There are bigger considerations there, which you need to talk to experts to about sort of digging into them and finding out what's appropriate. So I'll now come to you for your last comments, and then wind up for the day. Zorawar, what do you think? Last thoughts.
Look, from my perspective, first of all, pleasure. Thanks for inviting me. I think the market is as you've rightly said, clients need to be flexible to be able to allow their agent to be able to deal with the market as best they can. They need to set the risk parameters, and it's our job to make sure that we stick to those risk parameters. I think cash reinvestment seems to have got an ugly name because people may have lost money, but I don't think that's cash reinvestment that went wrong. It's the investment policy that needs to be looked at. And I think we are very open to take a consultative approach to working with clients, to actually working with our risk management partners, exposing them to the client so that the two risk managers can have a meeting of the minds as well. So from my perspective, I think cash is a great asset class. There's a reason they say cash is king. I think we need to embrace that. We at Deutsche Bank are very much of the opinion that clients need to be nimble enough, and therefore cash should not be taken off the table. It is one of the things that you need to allow. You need to allow non-cash trades. You need to consider guidelines. It's all one and the same thing. And look, we've been doing it for many a decade, and from our perspective, that expertise is available to the market to come to us and talk to us about.
Yeah, thanks. And I think I should again say the fact that I'm saying every 7, 12, 20 years is a problem actually tells you that means that there's only very occasionally a problem. And usually it's because of something that people haven't considered. So I want to put that into context as well. This is still fundamentally an incredibly low risk business, whether it's cash collateral or not cash collateral. And I think, Zorawar, as you said, it's about the cash investment policy that determines what your risk levels are. So yeah, just wanted to add to that. John,
look, I think you both actually summed it up very well. And look, Roy, you're absolutely right in that these things do happen on occasion. And just to quantify my earlier comment about Lehman, it's not that I don't think we should forget about it. I think that the reference to Lehman as a cause of something is getting a little old after 14 years. We know what happened. And it did, in fact, lead to, as Zorawar pointed out, a number of clients around the world suddenly moving into non-cash, as if up until that point, everything, all the years of cash reinvestment that they'd enjoyed suddenly was off the table. It isn't completely off the table, because if you look at, I understand that MBS is actually back in the US as a reinvestment vehicle of choice, but it isn't going to be the same as it was then. I think you're both right in that if you ignore an opportunity which is driven by the borrowers in terms of what they're prepared to give you, and you don't have something at a time when you need it the most, it's going to affect your program overall. Do clients need to understand that cash has some risks to them? Yes, but then they're going to mitigate that by having a fairly narrow band of permitted instruments. And if the spread, as Zorawar said, if the spread can be made in negative, positive territory, and that spread has a couple of basis points differential to doing it in non-cash over the course of a year, that could actually be significant. So I think it's if you're not taking cash collateral and never have done, there's nothing wrong with a project to explore it. Don't think there's any rush for it, especially in Europe, but I think it's something that you have to kind of either tick off and come to a conclusion about.
Yeah, I mean, arguably there would be a huge demand for people taking euro off someone else's hands, right? So banks would love that. So I think there is actually an opportunity there. I think the thing that did come up with Lehman, though, is what a lot of people, the reason that many people stopped taking cash collateral is what they found out was they ended up owning as collateral things that they couldn't buy outright. And that was really the lesson out of Lehman. And so I think that goes back again to the investment policy. You shouldn't end up owning something as cash collateral that you can't buy outright, and that's the big lesson there. Listen, there's a couple of questions from the audience that we haven't had a chance to get to. We will respond to those separately after the show, but we need to let everyone get back to their day job. Zorawar, thanks so much for being. It was a fascinating conversation. John, appreciate all of the input and again the ideas for that, and mostly. Thank you to the viewers. Thanks for sticking with us, and thanks for your questions and engagement. And we'll see you again next Wednesday.
Thanks very much.
Thank you very much.
Bye.
Bye-bye.